Now, a good place to start is my updated scenarios. I ran this model a couple of weeks ago, directly after the RBA decision. And what it shows is that the expectation is now for price rises, both units and houses, as the best case scenario. And even the base case, which is that we actually don't see anything in further cuts and inflation doesn't go away, still doesn't suggest much of a fall. And I think that's in line with the latest from CoreLogic. CoreLogic's National Home Value Index posted a 0.3% rise in February, breaking the short and shallow downturn that lasted just 3 months, they said, and dragging the national measure of home values 0.4% lower. The February rise was subtle but broad-based, they said, with every capital and rest of state region except Darwin was down 0.1% and regional Victoria, which was flat, recording a monthly rise in values. So what are we to make of all this? Well, my expectation is, as I said at the top of the show, is that we are going to see some further upward movements in home prices despite the unaffordable nature for many people at the moment. It's not going to be uniformly spread, and it's going to put more people closer to the edge, with the debt-to-income ratios for many households, particularly new ones, still sitting well above 50%. There is nothing here that is fundamentally changing the game other than piling extra pressure on more households for longer. And I do expect to see further announcements, further attempts to try and cajole more people into the market and to get more leveraged up. And of course, more people will play that game because they need somewhere to live. But the bottom line is this: there is nothing here to suggest a change of trajectory, nor a change of affordability. So those that pile into the market will continue to be under pressure, not just for weeks or months, but for years ahead.